Good afternoon and welcome to today's webinar. My name is Kyle DaCruz, Director of Digital Assets Product at VanEck, and we're fortunate enough today to be joined by Matthew Sigel, Head of Digital Assets Research at VanEck. So today we'd like to take some time to talk about Ethereum and what ETF developments mean for the underlying asset of the Ethereum blockchain, ETH. And so today we'd like to just quickly touch base on something we're very excited about, and that's the launch of the VanEck Ethereum Strategy ETF. So this was launched earlier this month. The ticker is EFUT or EFUT. And again, this strategy is meant to get exposure to Ethereum to investor today. Obviously, that's not available through a spot product. And so one way is to invest in Ethereum futures. And that's what this fund does here. And really, all of these funds in the market are effectively all investing in the same underlying asset, Ethereum futures. And so what one would do to differentiate really is only two things. One is cost, obviously, and the VanEck Ethereum Strategy ETF is currently the lowest with a net expense ratio of 66 basis points. And then the second is really how you structure the ETF product. And so we feel we've done this in a way that's really efficient for our investors, particularly long-term taxable investors. And we've done that through a C Corp structure. And so for more information on the C Corp structure and how that impacts investors' taxable liabilities, you can see this amazing document we've put together called The Tax Basics of a C Corp Structure, available on the VanEck website. And so certainly we're happy to take any questions about EFUT or ETH futures or the fund at all. But for now, let's kick it over to Matthew. We can get into what Ethereum is and how it impacts our fund.
Thanks, Kyle. Thanks, everyone, for joining. That really is the whole point of crypto in the end, is to hold your private keys yourself in a way that is free from censorship. But the reality is that structure doesn't work for a large part of the institutional market. And I would say today we were really reminded of the importance of a potential spot Bitcoin ETF, because we had a $2,000 green candle in a half an hour in Bitcoin today on a headline that hit the tape around 9 a.m. that the BlackRock ETF had been approved. That story has since been retracted, and Bitcoin has retraced most, but not all of its decline. The way I think about that kind of spot Bitcoin ETF is an ETF based on spot Bitcoin would essentially serve as a Bitcoin only exchange that is mainlined into every brokerage account in the country. So that could have a material impact on the appetite among regulated investment advisors who manage more than $4 trillion in assets. So a product like EFUT, Ethereum Futures ETF, probably a placeholder product on the way to a spot offering. At least we hope so. But for institutional investors who can't get access to these products by owning them on chain, if your clients are interested, we wanted to provide some education here and some context as to, what is this network and what is this asset. So here's our Ethereum at a glance slide, and I'd first just like to highlight that Ethereum and Bitcoin are very, very different assets. Bitcoin is mostly an inert asset. The Bitcoin blockchain is not Turing complete, which means it cannot execute the types of logical loops that are required for if X, then Y logic. So people for now are holding Bitcoin as digital gold. There is some optionality if the Bitcoin layer 2s can proliferate widely, but so far they have not. And in contrast to that, Ethereum is a general purpose computing environment which can execute that type of if X then Y computer logic. And that makes it very powerful for those who are trying to enter into commerce on the web and not just hold inert assets. So Ethereum is a profitable business. We estimate that Ethereum generated $2 billion in revenues over the last 12 months by charging for use of its blockchain. Ethereum hosts substantial commerce. Third-party businesses that deployed onto Ethereum's blockchain earned an additional $2.7 billion in revenue in the last 12 months. We estimate that Ethereum's total addressable market is nearly $8 trillion. That's an annual revenue number that we've broken out into three buckets: finance, banking, and payments, metaverse, social, and gaming, and then decentralized infrastructure such as cloud computing, server capacity, compute, et cetera. Right now, the vast majority of the available market is in traditional finance. That's why you see applications like Uniswap, which is a decentralized exchange, who are among the biggest consumers of gas on the Ethereum blockchain. But we think to be bullish on this asset, one should be bullish on the peer-to-peer exchange of all kinds of value, and a platform like Ethereum eventually serving as a disintermediator to some of the Web2 giants like Google and Facebook. Ethereum is decentralized permissionless software, so anybody can participate, join the network, validate transactions, deploy smart contracts, or exchange value within the system. And Ethereum is popular. So there's about 18 million monthly active users, and those users, just to pick one application, have sent more than $5 trillion worth of stable coins between them in the last year. And just to put that $5 trillion, $5.5 trillion in context, Visa facilitated $11 trillion in fiscal 2022, so exactly 2x the Ethereum stablecoin payments volume. PayPal did 1 trillion, so less than half of what ETH does. And it's interesting to think about Visa versus Ethereum, because at $500 billion market cap, Visa is more than 2.5 times the market cap of Ethereum, and yet it's facilitating exactly 2 times the payment volumes. And there are presidents of entire nations, and I'm thinking of Indonesia to be specific, who are making speeches explicitly calling for the disintermediation of Visa. So this is not to say that Ethereum will necessarily win that business, but if they do win a sizable portion, then the protocol could be undervalued based on the cash flows that it might produce. Next slide, Kyle.
Actually, Matthew, before we move on, can you just touch upon understanding clearly there's a TAM here, there's profits. Can you explain how token holders actually would realize those revenues? What happens? So typically, obviously, in equity, revenue is either used for CapEx or returns to shareholders. Can you explain how that revenue is distributed here on a blockchain like Ethereum?
Sure. So one can hold Ethereum and do nothing with it, or one can stake it, which means lock it up in such a way that those resources are used to power the computers that validate the transactions and ensure that the blockchain is operating efficiently. And when users pay Ethereum to perform transactions, either simple stablecoin transactions, which are very cheap, or more complicated swapping, borrowing, and lending, a portion of that Ethereum which is spent is returned to the validators and the stakers, those entities that have committed to locking up resources to power the computers that validate the networks. So it's a closed ecosystem in which ETH is the unit of account, and those entities that are committed to the network get rebated a form of those fees. And since the supply is, well, not limited, but the issuance is quite low, what we have ever since Ethereum transitioned to proof of stake is an asset that has a declining supply. So Ethereum has been deflationary ever since the merge, and that is due to all these transactions and a portion of the fees that are being paid being distributed to validators and stakers, and a portion being burned completely.
What?
Yep. So here we want to show the evolution of Ethereum's user base and revenues over the last 14 months. And this was an encouraging chart until August. You can see that both the number of users, which is on the right-hand scale, that's the line. So there's just shy of 18 million users on the blockchain in August of 2023. That number was below 16 million a year ago. So the growth has slowed down in the last 12 months, but it's still positive despite the bear market. And the fees, which also until August at least, we're in an uptrend, running, about $6 million per month. However, we should note that September 2023 was quite a poor month. Liquidity in the market dried up significantly, and the ETH fees in September was 93 million. So back down to September 2022 lows. Basically all of the progress that Ethereum made since its transition to proof of stake was reversed in September. So that's the definition of a bear market, but the number of users still not down year over year. Next slide, Kyle. So ETH, the asset, if you're a crypto observer, you may remember the viral exchange between House Financial Services Chairman Patrick McHenry and SEC Chair Gary Gensler a couple months ago, when McHenry asked Gary Gensler if ETH was a security and got a non-answer. And in a way, it's somewhat reasonable to squirm at that question because digital assets are kind of a unique hybrid of commodity, security, foreign exchange, and derivative, depending on their individual characteristics. So here we just try to lay out some of the characteristics of ETH, the asset. It's a useful commodity in the sense that all transactions and services that are performed on Ethereum require ETH, the asset, to be completed. The assets generate yield. Users who stake ETH earn a portion of the revenue that is generated by the network. And that's another slide that was not updated for September. Because of the declining recent transaction volume on the network, the Ethereum staking yield is now closer to 3.5%. And that kind of widening gap between the yield on T-bills and the yield on ETH has probably contributed to the bear market here, because investors who are looking for yield can find it more easily in the T-bill market. That's obviously true across the financial landscape, but nevertheless, ETH does earn yield about 3.5%. ETH has been deflationary ever since its transition to proof of stake in September 2022. Part of the reason for that is that a portion of the fees are burned, similar to share buyback. So ETH supply is currently declining at about 0.35% per year. A good proportion of ETH supply is being locked. About 22% of all Ethereum is locked in staking contracts. And if the staking momentum continues at the current pace, we estimate that number could be 28% within 6 months and 42% by year end next year. In fact, there are core developers within the Ethereum community who are lobbying to make changes to the protocol in order to slow down the pace of ETH staking because they are worried about illiquidity in the market, but those changes have not been executed yet. And number 5, ETH enhances security. Ethereum is protected by cryptography, economic design, and Ethereum's $200 billion market cap, which provides an insurance layer against bad actors. And I will describe that in the next slide. So these are some thoughts on the Ethereum network's security and what makes it so hard to attack or to dethrone as the #1 smart contract protocol. There are plenty of smart contracts that are hacked in crypto, lots of unaudited smart contracts issued by scammers. We know this to be true, but the Ethereum network is unique in that just the scale of assets committed to its security. So if we multiply the Ethereum market cap by the percentage of Ethereum which is staked, we end up with $50 billion worth of Ethereum staked by validators who would lose that money if they didn't stay honest. So if one of those validators validates blocks incorrectly or tries to double spend that ETH, they lose it. Staked ETH also helps to decentralize the network because now anyone with 32 Ethereum can directly participate in the consensus process and help secure the network. And that helps any one entity from gaining too much control over the network. Next slide, Kyle. So I'm not going to read all these, and please do ask for the slides. But there's 4 different points to this slide. The first is that the cost of transacting on Ethereum varies widely based on how complex the transaction is. So DEX trades, decentralized exchange trades, are a lot pricier than a simple stablecoin payment or transfer. Number 2 is that Ethereum users, even when they're on a layer 2 or using an application, pay Ethereum fees, not the DApp deployed on Ethereum. So the analogy is as if you went to a mall and bought a pair of shoes and the price tag showed not only the price of the shoes, but also the rent that store was paying the mall. And that's a theme throughout a lot of crypto, is that it's an a la carte asset class. People like Visa because it's bundled. They like the refundability, the fraud protection, the free short-term line of credit. In crypto and on the Ethereum network, all those functions are discrete. Number 3, when comparing Ethereum to a traditional payments network, we look at the Ethereum fees as a take rate. So as a percentage of the total business activity that is occurring on chain. And we use that ratio to inform our estimates for how profitable the blockchain could be and how much market share it might take from centralized Web 2 competitors. And number 4 is basically repeating number 1, which is that these ETH fees vary very widely. So for Web3 applications like social media or complex swaps, that can introduce a little bit of friction because the Ethereum take rates are much higher in these types of applications than they are for at making kind of simple transfers. Next slide. Thank you, Kyle. So with that as a background, here are some of the numbers to help you contextualize the business that Ethereum is facilitating. And keep in mind that these are only for third-party sales. These don't count primary sales for the Web 2 companies that were cited. So tell you how this chart works, and the y-axis is logarithmic, so careful. Amazon collects $117 billion in revenues from sales made by third parties. So the total sales made by those third parties is like more than 300 billion. Amazon books 117 billion in their top line. The take rate is about 28%. Google Play earned about $13 billion for Google on behalf of third-party sellers. The Google Play take rate is 30%. For Ethereum, users are paying a total of almost $4 billion to transact either on the L1 or a DApp or on the L2, and then ETH, the asset in the form of gas fees that are paid, captures about $1 billion of that, or 28%. And then, ETH has a whole other 50% of revenues that come from kind of directly on the platform without using dApps or L2s. And the breakdown for Amazon, right, is like 2/3 of their revenues are third party and 1/3 are first party. For Ethereum, it's more like 50-50. But with the network upgrade that is coming next year, that will enable something called proto-dank sharding, which is going to make it much cheaper for L2s to transact on the main chain. We would also expect L2s to continue to take market share from the L1. But this chart just kind of shows that Ethereum commands a great amount of pricing power when users are using L2s and third-party dApps. And the pricing power is equivalent to what the Web 2 giants earn, like Amazon, Apple, Uber, etc. Next slide, Kyle. Now here's another way I look at it, and I made the point 2 slides previously that Ethereum fees can vary extremely widely, and that it's much more expensive to perform a complex transaction than it is to do a simple transfer. Here we've done just the apples to apples cost of a simple transfer. So the $5+ trillion of stablecoins sent on ETH, and we're just taking the total gas costs of those stablecoins divided by the total stablecoin volume in USD, and you end up with something like less than 10 basis points. So extremely cheap to perform simple transfers, especially compared to any of these Web 2 companies like Visa, MasterCard, PayPal, Stripe, etc. Next slide, Kyle. Right. So who exactly is paying all these gas fees, and what are they doing? And this chart helps inform some of the evaluation work that we've done on this asset. Please feel free to Google like VanEck Ethereum, and it'll come up right away, like how we model these assets. But one way of thinking about it is what are the use cases that people are performing, and then we look at those use cases in the Web 2 world, and we look at what type of pricing power the leading players have, and in that way we can perform more detailed analysis. Go back, there you are, Kyle. So what you see here is that the majority of gas fees are coming from payments and finance, and with a much smaller percentage, but growing for layer 2s, shrinking for NFTs. I thought it would be helpful just to give you like the single name of what is the largest gas guzzler within each of these categories. So the largest payments gas guzzler is Tether. The largest finance gas guzzler is Uniswap. The largest gaming gas guzzler is ApeCoin, which is the coin that governs the Bored Ape ecosystem. The largest infrastructure gas guzzler is MetaMask, which is a wallet. The largest social application is ENS, which is the Ethereum naming service. The largest layer 2 is ZK Sync, which is a zero knowledge protocol layer 2. And the largest NFT platform is OpenSea for now. Next slide, Kyle. Thank you. So another crucial data set that we watch when evaluating the health of these ecosystems is the market share of total fees paid across all blockchains. And here you can see that Ethereum really dominates. It's one of a very small handful of profitable blockchains that produce free cash flow for stakers and validators. And its market share has varied between 60 to 80% over the last 2 or so years. Next slide, Kyle. Thank you. And lastly, when we evaluate these layer 1 blockchains, we look at the developer ecosystem. These are all open source projects, so you need to have a large number of motivated and money-making developers. Otherwise, there's no new applications. So on that metric, ETH is very healthy indeed. 3 years ago, all open source blockchain developers, about 40% or so were developing on ETH. Now that number has just surpassed 50% for the first time. So I think one of the major questions for digital assets is to what extent will they exhibit the same type of winner-take-all characteristics that we've seen in Web 2, where the top 1% of content creators on YouTube are earning 90% of the fees. And the top, 7 stocks in the NASDAQ have a record percentage of the market cap. We all have different views on this, but my personal view is that there are extreme scale benefits, and network effects. And when we model each of these blockchains, we essentially assume that they capture 80% of the relevant market, and then we look at them as call options on that success. And based on this chart, at least, Ethereum tends to be trending in that direction. When you look at the performance of Ethereum and Bitcoin versus all the other tail of liquid tokens this year, it furthers that narrative. I do think there'll be a hugely long tail of assets because crypto really enables capital formation by anyone with very low friction. But in terms of where the lion's share of value is created and captured, I think it'll be in Bitcoin and ETH and a handful of other chains. Next slide. Okay, and lastly, we just wanted to look at a snapshot of the valuation of Ethereum versus some of the Web2 giants. And you can see that on a price to sales basis, we have Ethereum at 75 times, but their revenue CAGR is 200%. Since 2020, the most expensive among the peers, but we also think it's likely, if not possible, that Ethereum network growth continues to surpass many of these other platforms based on de-dollarization and additional applications being rolled out on the chain that make mass adoption more and more likely. I think next year with the Bitcoin halving and the US election and the potential for spot ETFs to be approved, that it lines up perfectly with the 4-year cycle for a crypto. If BTC works, Ethereum traditionally works even better. And personally don't think that investors are going to be too scared off by 75 times revenues if the user activity materializes. That's all I have on prepared remarks. We just have some of our sources here at the back, and yeah, would love to take some of these questions.
Absolutely, we have a few, and please, if you have any questions, please click on the Q&A box located at the bottom of your screen and submit some through there, and we'll address those as they come along. So Matthew, there are a few already. What metrics does your team use to come up with prices for any of these digital coins?
Yeah, so I think like with all these digital assets, you have to start with a framework for what type of penetration open source blockchains in aggregate can achieve. Is that 1% of the TAM for financial services businesses? Is it 10%? Is it 50%? We arrive at somewhere around 5%. And then we look at what type of free cash flow the protocol could generate if they're capturing a certain percentage of each transaction. So that's a lot easier to do when the coin has a fixed supply or a very transparent monetary policy. It becomes much harder to do when there is limitless supply. But in the case of Ethereum, the ecosystem is very well studied, and there are a number of both open source and proprietary data sources that can track in real time the fees and the revenues that each protocol can produce. So, the simplest thing to do is you look at the last 24 hours of fees and multiply it by 365. That's extremely crude. You have to make some assumptions on what pricing is going to look like. But these projects don't have typical expenses like physical infrastructure or employees. So the margin profile can be quite positive. We estimate about 50% right now for Ethereum.
Right, and we have a few more questions here. So there's one question here. There are some EVM-based layer ones like Avalanche. Why would an application choose to build on an Avalanche subnet over an Ethereum L2 app chain? So Matthew, maybe before you dive into that, for our listeners that maybe are not as familiar with the ecosystem, maybe we can explain what an L2 is and why someone would choose to use an L2 or launch an L2 before we answer the question directly.
Yeah. So the Ethereum blockchain is capacity constrained. It's quite expensive to run a globally distributed network like this, and during periods of network congestion, the fees can rise very quickly. So the network was architected in a very composable manner where it's possible to just layer on another blockchain, which is inserted onto Ethereum chain in the form of a smart contract, essentially. And then that chain can have its own parameters for who's allowed to validate, how are the fees calculated. But those so-called layer 2 chains will use Ethereum main chain for data availability and security and the eventual settlement of transactions, and they pay Ethereum for that right. But because the layer 2 is bundling lots of transactions together, they can offer a price to the user which can be 1 or 2 order of magnitudes cheaper. So users will choose to pay that smaller amount, although oftentimes they may be sacrificing on censorship resistance by doing so. As the questioner notes, there are a number of other layer 1s like Avalanche that are compatible with the Ethereum virtual machine, which is the format for Ethereum's smart contracts. I think that in that kind of B2B2C model, the users, which is a business essentially, there's a lot of business development involved. So many of these L1s have companies and foundations that have been endowed with sizable treasuries denominated in their own coin, and they basically see it as their job to hand out that value in order to get developers excited about building on the chain. But what we've seen throughout this bear market is that bribing developers to come to your chain with your own treasury holdings have not really driven mass adoption, and more of the community seems to be coalescing around Ethereum and its L2s rather than using other EVM compatible L1s like Avalanche. But I mean, the positive would be transaction costs are often cheaper on some of these other chains.
Got it. A question is, who owns ETH? I assume they mean Ethereum blockchain, not ETH the asset. Maybe this dives into a question on public goods and exactly who owns that, but if you want to take that one.
Yeah, so there's roughly 100 million ETH outstanding. No single entity owns more than 4 million, and those are generally like exchanges that are holding them on behalf of clients. So even like Vitalik Buterin, I think, owns like around 200,000 ETH or something. So it is pretty distributed. Nobody controls the asset.
Right, we have a few more questions here. In the context of increasing interest in ETH ETFs, I assume both futures-based and spot, what are the potential implications today of ETH futures affecting the Ethereum ecosystem?
Well, VanEck has pledged 10% of the profits from our EFUT fund to Protocol Guild, which is a decentralized autonomous organization comprised of Ethereum mainnet developers. So we're pleased to be giving back a little bit to this ecosystem and help the Ethereum developers maintain the health of this chain. But other than that, I mean, not a ton.
Got it. And what regulatory challenges and considerations were involved in launching an ETH futures ETF? And maybe I can start on that one.
Yeah, you take that one, Kyle.
Yeah, of course. I think So I don't think it was a challenge. I think the SEC clearly was ready to approve an Ethereum futures type of product, in which they allowed VanEck as well as others to come to market with. I think it's a few things. One, Ethereum futures, ETFs invest in Ethereum futures. These are not spot products. And I think the regulators have proven comfort in launching ETF products that invest in these futures-based products, like they did 2 years back with Bitcoin futures ETFs. So there's precedent. Those Bitcoin ETF products have been in the market for a couple of years. Everything has been working and nothing is broken to date. So I think there's precedent. I think there's comfort. And I hope, again, these may not have made the largest splash in the market, but I think it does represent another important step with increasing comfort by regulators and getting investors exposure to these assets today. All right. Matthew, what is the impact of ETH staking on the futures curve? If any?
I don't have a strong view on that. I mean, I was just looking at the futures curves in general for ETH and Bitcoin, like 90% of the time they're in contango. So meaning that the curve is upwardly sloping. I don't have a strong view on like the staking's impact on the futures curve.
Right. And I think that's all the questions we have. If we didn't get to any of your questions today, please reach out. Our email info@vaneck.com, where you can also request the slides from today and answers to any questions that maybe we didn't get to or you didn't have a chance to submit today. I'd like to thank again Matthew Sigel, head of digital assets research for VanEck. Hopefully this was not only entertaining, but hopefully educational for you all. And hopefully that 44% audience feels like they may be graduating to 201 after this. But thank you all and have a great day.
Thanks, Kyle.